an introduction to bonds and how they work. Welcome to our detailed exploration into bonds. Today, we're going to cover everything essential about bonds. This includes what bonds are, how they function, their various types, the benefits and risks associated with them, and how you can begin investing in them. This guide aims to provide a thorough understanding of bonds for anyone interested in investing, whether you're a newcomer to the investment world or someone seeking to expand their investment horizons. Let's dive in. Part 1. Understanding bonds. What is a bond? Simply put, a bond is essentially a loan made by an investor to a borrower. The borrower could be a corporation, a government, or a municipality. By purchasing a bond, you are lending money to the bond issuer in exchange for periodic interest payments plus the return of the bond's face value when it matures. Bonds are thus considered a fixed income investment, offering a consistent income stream over time. Why do entities issue bonds? Corporations issue bonds to raise funds for various reasons, such as business expansion, new projects, or refinancing existing debt. Governments and municipalities might issue bonds to finance public projects like infrastructure, education, and healthcare. The components of a bond: principal, the face value of the bond, repaid to the investor at maturity; coupon rate, the interest rate paid by the bond issuer to the bondholder, determining the periodic interest payments received; maturity, the date on which the bond's principal is repaid. Bonds can be short-term up to 5 years, medium-term 5 to 12 years, or long-term more than 12 years. Issuer, the entity that issues the bond, which could be a corporation, government, or municipality. Part 2. Types of bonds. Bonds vary in form, each with unique characteristics and purposes. Government bonds, issued by national governments. These are among the safest investments, backed by government credit. US Treasury bonds are a prime example, known for their security. Municipal bonds, issued by states, cities, or counties to fund public projects. They often offer tax-free interest, appealing to those in higher tax brackets. Corporate bonds, issued by corporations to raise capital. These usually offer higher interest rates than government and municipal bonds due to higher default risks. International bonds, issued by foreign entities. These can add diversification, but carry risks like currency fluctuation and political instability. Part 3. Benefits and risks of investing in bonds. Investing in bonds has its pros and cons. Benefits: income stability. Bonds offer predictable income through regular interest payments. Diversification. Bonds can reduce portfolio volatility and risk. Safety. Some bonds, especially government ones, are low risk. Risks: interest rate risk. Bond prices fall when interest rates rise, especially for long-term bonds. Credit risk. The risk of issuers defaulting on payments, more common with corporate bonds. Inflation risk. Inflation can diminish the future purchasing power of bond payments. Part 4. How to start investing in bonds. Assess your goals. Identify your investment objectives, risk tolerance, and horizon. Research. Explore different bond types and characteristics to find what suits you. Diversify. Mitigate risk by diversifying across government, municipal, and corporate bonds. Purchase. Buy bonds through brokers, online platforms, or directly from issuers in some cases. Conclusion. Bonds are a cornerstone of a diversified investment portfolio, balancing risk and return. A good grasp of how bonds work, the types available, their benefits and risks, and investment strategies is crucial for any investor. Bonds offer stability, income, or diversification, depending on your needs. Successful bond investing requires research and a clear understanding of your investment goals. This concludes our guide to bonds. We hope you now feel more confident navigating the bond market. If you found this guide helpful, don't forget to like, share, and subscribe for more investment insights. Happy investing!